Most people who have a mortgage are overpaying for it every single month. And I do not mean they bought too expensive a house. I mean the structure of how they are financing it is costing them more than it has to. And almost nobody who sold them that mortgage explained the tools available to change it. That is what a cheat code actually is in real estate. It is not a secret loophole or some trick that only insiders know. It is a legitimate mechanism that exists inside the standard mortgage system that your lender is not going to walk you through unprompted, that can materially change how much your home costs you over its lifetime. And the version I want to walk through today is one of the most underused things I have seen in 10 years of working with buyers and homeowners. Before I get into the mechanics, I want to hear from you. If you have a mortgage right now, do you know your exact interest rate and how many years you have left on it? Drop the numbers in the comments. Most people cannot answer that question without looking it up, and that gap between owning a mortgage and understanding it is exactly where this conversation starts. And that gap between owning a mortgage and actually understanding it is exactly where this conversation starts. I have been in real estate for about a decade. I have helped a lot of closings. I have watched a lot of loan officers explain a lot of things. And the thing that has always bothered me about how mortgages get sold is that the entire process is designed around getting you to close, not around making sure you actually understand what you are signing up for the next 30 years. The closing table is a strange place. There are stacks of documents. Everyone is in a hurry. There is a notary. There might be champagne involved somewhere. And somewhere in that stack is the amortization schedule for your loan, which shows you exactly how every single one of your payments will be split between interest and principal for the next 30 years. It is all right there, and almost no one reads it. The lender does not walk you through it. The real estate agent has usually left by that point, and you have just committed to a financial obligation that will shape your family's life for 3 decades. The lender wants the loan on their books. The agent wants the transaction done. The title company wants the paperwork signed. Everybody at that table has an incentive to move you through the process as efficiently as possible. And almost nobody has a structural incentive to slow down and make sure you actually understand what you signed up for. So most people walk out of closing with a 30-year obligation. They understand it about a surface level. They know the monthly payment. They know the rate roughly. They could not explain how amortization works if you asked them to. So let me do that now, because this is the foundation of what I want to talk about. And if you do not understand amortization, the cheat code does not make sense. And I mean actually understand it, not just know that the word exists. Most people know they have a mortgage payment. Some people know their interest rate. Almost nobody can tell you how much of their last payment went to interest versus principal without looking it up. And that gap is where this whole conversation lives. When you take out a 30-year mortgage, your monthly payment is fixed. Same number every month for 30 years, but the split between what goes to interest and what goes to principal is not fixed. It changes every single month according to a schedule called an amortization schedule. And in the early years of your mortgage, that split is brutal. In the first year of a typical mortgage, at current rates, somewhere around 60 to 70% of every payment you make goes straight to interest. Think about that for a second. You signed up for a 30-year commitment. You are making payments faithfully every month. You feel like you are making progress. And the overwhelming majority of what you are sending in is not reducing your balance at all, not to owning more of your home, not to building equity, to the bank as the cost of borrowing. You are paying close to $1,000 a month, and $600 or $700 of it is just the interest charge. The principal balance is barely moving. This is not a scandal. It is just how compound interest works in reverse when you are the borrower instead of the investor. But most people have a vague sense that their mortgage payment is building equity steadily month after month, which is true in the loosest sense but deeply misleading in practice. In year 1, you are building equity slowly. In year 2, slightly less slowly. By year 15, you are finally past the halfway point where more of each payment goes to principal than to interest. By that point, you have made 15 years of payments and you still owe more than half the original balance in a lot of cases. This is the reality of how a standard 30-year mortgage actually works. Now, here is where the cheat code comes in. Because amortization is front loaded with interest, any extra principal you pay early in the loan has an outsized impact on the total interest you pay over the life of the mortgage. Every dollar of principal you reduce early means the interest charge calculated on that balance next month is also slightly lower, and that compounds forward through the entire remaining life of the loan. The specific mechanism I want to talk about is called biweekly mortgage payments, and I want to be clear up front. This is not the same as the biweekly payment programs that some lenders and third-party companies try to charge you a fee to set up. Those programs exist, and they work, but you do not need to pay anyone anything to accomplish the same thing yourself. I will explain both versions. Here is the basic math. A standard mortgage is structured around 12 monthly payments per year. If you switch to paying half your monthly payment every 2 weeks instead, you end up making 26 half payments per year. 26 half payments equals 13 full payments. So instead of 12 payments per year, you are effectively making 13. One extra full payment per year applied entirely to principal. That is the whole mechanism. It sounds almost too simple to matter, one extra payment per year, but because of how amortization works, because early payments are overwhelmingly interest, and any extra principal dramatically changes the math of every subsequent payment, that one additional payment has compounding effects throughout the entire remaining life of the loan. It is not just one payment, it is one payment that subtly changes the trajectory of every payment that comes after it. That one extra payment per year, applied consistently over the life of a 30-year mortgage, does something significant. It cuts years off the back end of your loan. On a typical mortgage at current rates, the difference between 12 annual payments and 13 is somewhere in the range of 4 to 6 years of payments eliminated entirely. You pay off the loan years earlier. And because you are eliminating years from the end of the loan, the years when the balance is lower and the interest charges are smaller, the total interest savings over the life of the loan can still be substantial. I want to give you a concrete example with numbers I have not used in any other video. Take a mortgage balance of $450,000 at a 6.8% rate, 30-year term. Your standard monthly payment on that is roughly $2,940, not including taxes and insurance. Over 30 years of payments, that is a total outlay of about $1,058,000. Your loan was $450,000. You will pay roughly $608,000 in interest over 30 years at that rate. Now add one extra monthly payment per year applied entirely to principal. Just one. That shortens your loan by approximately 4.5 years and reduces your total interest paid by somewhere around $90,000. You made 31 payments per year instead of 12 for 25.5 years instead of 30, and the difference is $90,000 and 4.5 years of your life that you no longer owe payments on. $90,000 from one extra payment per year. Now, the biweekly approach accomplishes this automatically because the math of 26 half payments naturally produces that 13th annual payment without you having to think about it or remember to do it. You set it up once, it runs, and the consistency is the whole point. I want to tell you about a client I worked with a few years back. She bought her first home in her early 30s, single income, modest down payment, stretched herself reasonably to get into a neighborhood she wanted to be in long term. When we closed, her rate was solid for the time. She asked me afterward whether there was anything she should be doing that most buyers do not think about. I told her about biweekly payments. She set it up with her bank directly. Her bank offered this at no cost, you just have to ask. And she forgot about it. Same effective amount going out per month, just split differently. She did not change her lifestyle or her budget in any meaningful way. I ran into her a couple of years later at an open house I was hosting. We were catching up and she mentioned, almost in passing, that she had recently gotten a statement from her servicer showing her updated payoff projection. She was on track to pay off her mortgage about 5 years ahead of schedule. 5 years. Off a 30-year loan. She had not refinanced. She had not made dramatic extra payments or changed her lifestyle in any meaningful way. She had not found a second income or done anything that required significant effort or sacrifice after the initial setup. She had just changed the timing structure of when her payments were applied, set it up automatically, and then gone back to living her life. The system did the rest. That conversation is why I bring this up every time I am talking to someone who just bought a home or is thinking about it. Now, I want to address something directly because I know it is coming. In an earlier video, I talked about why extra mortgage payments are not always the best use of extra money compared to investing, and that is still true. If you have extra cash to deploy, the comparison between accelerating your mortgage and investing in a broad index fund is real, and the math often favors investing over the long run, especially at moderate mortgage rates. But biweekly payments are a different category of decision. You are not deploying extra savings. You are restructuring the timing of money you are already going to spend on your mortgage payment. The monthly outflow is essentially the same. Half your payment every 2 weeks rather than the full payment once a month. The practical budget impact is minimal for most people, but the structural impact on the loan is significant because of how amortization front loads interest. So the right frame for this is not extra mortgage payments versus investing. It is restructuring an existing obligation to reduce its total cost at minimal behavioral friction. That is a different calculation entirely. Let me walk through how to actually do this, because there are a few versions and they are not all equal. The first version is the direct biweekly setup through your lender. Call your mortgage servicer and ask if they offer a biweekly payment option at no cost. Many do. You set up automatic payments from your bank account every 2 weeks for half your monthly payment amount. The servicer holds the first half payment until they receive the second, then applies the full payment. This costs you nothing and accomplishes exactly what I described. The second version is a DIY approximation that works if your servicer does not offer bi-weekly at no cost. Divide your monthly payment by 12. Add that amount to every monthly payment as extra principal. This is mathematically equivalent to making one extra payment per year and produces nearly the same result. While some people find this easier to manage because it stays on a monthly rhythm. The key is to specify that the extra amount goes to principal only. Write it on the check or flag it in your online payment portal. If you do not specify, the servicer may apply it differently. The third version is what some banks and third-party companies try to sell you, where they charge a setup fee or an ongoing monthly fee to manage the biweekly process on your behalf. I want to be direct about this. 1. Do not pay for it. The outcome is mathematically identical to what I just described, and you can replicate it yourself for free in a single phone call to your servicer. These programs exist specifically because most homeowners do not know they can do this themselves. The fee is not for a service you cannot access otherwise. It is for information you now have. One thing to check before you set any of this up: prepayment penalties. Most conventional mortgages today do not have them, but some do, especially on certain loan types. Call your servicer and confirm you have no prepayment penalty before making any extra principal payments. This is a 5-minute call that could save you from a surprise. There is a broader principle underneath all of this that I think is worth naming directly. The mortgage system is not designed to help you pay less. It is designed to collect the maximum interest consistent with you being able to make the payment. That is not a moral judgment, and I am not suggesting your lender is acting in bad faith. That is just how loan products work in a market economy. The bank is a business, the loan is a product, the product is priced to generate a return, and the bank has no obligation to help you minimize that return. The product is priced to generate a return for the institution, and the interest schedule is how that return is structured. Every mechanism that reduces your interest cost, biweekly payments, extra principal, refinancing at a better rate, requires you to actively seek it out and implement it yourself. The lender will not call you with suggestions. The servicer will not send you a letter explaining how to pay them less. The real estate agent who helped you buy the home has moved on to the next transaction. The closing attorney filed the paperwork and went to the next closing. Nobody in that process is positioned to follow up with you 6 months later and say, hey, here is something you should know about your loan. The information is available, the tools are available, the mechanism is straightforward. It just requires you to go find it. This is not a conspiracy. It is just how financial products work. The product is designed to be profitable for the institution selling it. The tools that make it less profitable for them and more profitable for you are technically available, documented in your loan paperwork, perfectly legal, and almost never discussed in the closing room. That is what makes this a cheat code. It is not secret. The system is simply designed so that you only find it if you go looking. The biweekly setup is the lowest friction version of this. You do it once and it runs. But there is a second mechanism worth knowing, one that requires more active engagement but can produce even larger savings depending on where rates go. Refinancing. If you bought your home when rates were higher than where they are now, or if rates drop meaningfully at some point in the next few years, refinancing into a lower rate can produce significant savings. The math is straightforward. A lower rate means a lower interest charge on every payment for the rest of the loan. The question is always whether the closing costs of the refinance are justified by the savings, and the standard rule of thumb is to look at the break-even point. If it costs you $4,000 to refinance and you save $200 a month, your break-even is 20 months. If you plan to stay in the home longer than 20 months, the refinance makes sense on paper. Where people get this wrong is by refinancing into a new 30-year term every time, rather than matching the remaining term of their existing loan. If you are 12 years into a 30-year mortgage and you refinance into a new 30-year loan at a lower rate, the monthly payment drops, which feels good, but you have reset your loan clock. You now owe 30 more years instead of 18. Your total interest over the combined life of both loans may actually be higher than if you had stayed in the original. The right move is to refinance into a term matching your remaining years. 18-year term in that example, not 30. Most lenders offer this. Most borrowers do not ask for it. I also want to address paying points to buy down your rate at origination. Mortgage points are prepaid interest. You pay up front in exchange for a lower rate for the life of the loan. 1 point typically costs 1% of the loan amount and buys down your rate by some fraction of a point, varying by lender and market. Whether it makes sense depends entirely on how long you plan to stay in the home. If you are confident you are staying long term, 10 years minimum, paying points can absolutely make sense, and the break-even math is straightforward to calculate. Divide the upfront cost by your monthly savings to find your break-even month. Then compare that to your realistic timeline. If you plan to be there well past that break-even point, points make sense. If there is any meaningful chance you will sell or refinance in the next 5 years, paying points is usually a mistake. The upfront cost rarely recoups in a short time horizon, and you end up having prepaid interest on a loan you no longer have. The broader point across all of these is that your mortgage is not a static object. It is a financial product with levers, and most of those levers are accessible if you know they exist. The people who treat their mortgage as a fixed obligation that just runs in the background tend to pay significantly more over the life of the loan than the people who engage with it occasionally and adjust when the math supports it. I want to close with something I think about when I picture what this actually means in real life. Not $90,000 as an abstract number, but what those years at the end of your mortgage actually look like. Imagine yourself at 58 instead of 63. The mortgage is paid off, you have the same income you have now, probably more, but the biggest fixed monthly obligation in your budget is gone. What does that change? It changes how much risk you can take at work. If you want to start something on the side, the math on doing that is different when your housing cost is zero. If your company goes through a rough patch, the pressure on you is different when you are not carrying a mortgage payment. If you want to spend a summer doing something with your kid before he leaves for college, that calculation changes completely when the house is paid off. It also changes how you think about retirement. The standard retirement planning conversation assumes you are still carrying a mortgage payment into your 60s. If you are not, if the house is clear 5 years earlier than the loan schedule said, your required retirement income drops significantly. the number you need to have saved to sustain your lifestyle goes down. That is not a small thing when you are building toward a finish line. That is what 4 to 6 years of eliminated mortgage payments actually buys. Not just the money, the options that come with not owing it, the flexibility that comes with owning your home outright years earlier than you were supposed to. One phone call to your mortgage servicer, ask if they offer biweekly payments at no cost. If they do, set it up. If they do not, add 1/12 of your payment to principal every month. That is really the whole ask. I will see you in the next one.